This is FRM Part 1, Book 1, Foundations of Risk Management, and the chapter on the anatomy of the Great Financial Crisis of 2007 and 2009. After this reading, you ought to be able to describe historical background and an overview of the 2007 to 2009 financial crisis, describe the buildup, assess the consequences of the Lehman failure. Remember, Lehman Brothers was this gigantic investment banking firm that failed, and that had consequences not only inside the Lehman Brothers world, but also in the surrounding financial community. Describe the historical background. I love history lessons, so that'll be good. Distinguish between two main panic periods. And then, of course, ask ourselves the question, how did government policies and laws and regulations, how did government policy responses help us or hurt us? And then taking a look at the financial crisis and its impact on the larger global environment. Let's start with a history lesson. A banking crisis can be defined by the existence of the following events: maybe a closure or a merging or a takeover of a specific financial institution, or maybe a group of financial institutions due to bank runs. I always think of bank runs as the pictures that used to be in my old time corporate finance textbooks when I was an undergraduate of, people standing around for blocks and blocks back in the 1930s waiting to get some of their deposits. Nowadays, you don't really have to have people standing outside of a bank to have a bank run. But another event in the absence of bank runs is a large-scale government assistance of an important financial institution, or maybe a couple of financial institutions, which is kind of a signal that if this one really important financial institution is in trouble, if it is failing, that might have implications for other similar large-scale banks. Now, what we know is that prior to most financial crises, there seems to be a scenario under which lots of institutions continue to borrow money and they continue to issue debt. And of course, this is all good if the economy expands and those borrowers are able to generate cash flows to be able to repay the debt service. But when the economy contracts or there's a liquidity issue like we talked about in the previous reading, then it makes those debt service payments even more difficult. And when it occurs inside of the financial services industry, it has repercussions through the entire economy. Lots of sovereign debt crises are often preceded by banking crises that occur inside of a particular country. It doesn't have to be just developing countries. This is true for developed countries as well. How about the 2007-2009 crisis? So we need to have a little bit of a history lesson here. So let's go back to the 1990s, where we had great economic expansion under President Bill Clinton. But in the end of the 90s, remember, this is where the tech stocks and the internet stocks started to take off. So we had a bubble, we had irrational exuberance. And then remember, we had multiple corporations who were guilty of kind of misleading us, fraud, misrepresentation. How about if we just say they lied to us on their financial statements? And so we believed them, right? Because the auditors signed off on them. And so we continue to bid the price of these things up. So then we find out that these tech stocks and these internet stocks, they might not be as profitable as we thought they were going to be. Plus, maybe lots of companies are going to lie to us about their financial performance. And then we had September 11th, and so there was an economic breakdown, in 2000 and 2001. And this was true not just in the United States, but throughout the world. Now, the International Monetary Fund described this crisis as the worst one since the 1930s. And of course, what we're doing, and we're contributing this as we did back in the previous chapter, that it started and maybe ended inside the U.S. real estate market, in particular because of the emergence of subprime mortgages and the proliferation of these mortgages. All right, let's go back to December of 2007 and then extend ourselves 19 months to 2009. That's kind of the general time period that most people view as the chronology of the crisis. So what are some causes, or what are some reasons, or what are some actions that contributed to this? Well, there's no doubt that the government had a big influence, because during the Bill Clinton years and then continued through the second George Bush years, Congress and the president supported this. There was legislation aimed at the goal of increasing home ownership. And so that sounds like a great societal goal, because what sociologists and economists tell us is that economies and families and individuals are more stable if they live in a home. And so the government decided, hey, let's decide to pass laws that make it easy for people to own homes. Comma, there has to be a comma there. This is all good if all those people can afford to live in those homes. But what happened is that not only it put individuals and families into homes that they couldn't afford, it put individuals and families from homes that they could afford into homes that they could not afford. So there's two parts to that. Now, the government encouraged banks to extend mortgages to a broader base, so that there was a narrowing of the gap between the poor and the middle class. Affordable housing legislation, favorable mortgage terms. So what does that mean, affordable housing legislation? That means that if you come in and apply for a loan, you don't have to have this much in income or this much in assets. All you have to have is this much or this much. So they lowered those rules. And then favorable mortgage terms means that, hey, perhaps you could get a floating rate mortgage with a much lower interest rate, or an interest-only mortgage in which you only paid interest for a few time periods, maybe a year or two, or maybe you could delay or defer the interest payments, or financial institutions were coming up with all kinds of fascinating financial engineering plans to make those terms more favorable. Now, here's a good picture of the housing bubble. So go back to 1985. What was that? That was about the middle of the Ronald Reagan years. Notice then there was an uptick, but then through the end of the George Bush and then the beginning of Bill Clinton years, there was a downward trend. But then starting in 1995, then for 10 years or however long it was, I mean, look at that graph out there. Housing prices consistently rose, and they rose at far greater rates over that time period than they had in the past. Look at that second bullet point here. Boy, it pains me to even read this one. There was a general consensus that prices would continue to rise indefinitely. This is like thinking that Tom Brady is going to win every Super Bowl for the rest of our lives. Sooner or later, Tom Brady gets old. I mean, it's a fact of life. Didn't we learn that by watching The Sting? Didn't Paul Newman say that's a fact of life? You get old. And so it's just amazing to me that individuals and institutions would think that prices are just going to rise indefinitely. Now, of course, the extra leverage and the pressure on mortgage payments is okay as long as the economy is expanding and as long as housing prices are rising. But as soon as that stops, then we got a big problem. Look at this third bullet point. Housing construction fell, GDP and consumption slowed. So what does that sound like? You got less construction, you have consumption slowing. So instead of my children buying 10 PlayStation 4 games a year, they only buy 4 PlayStation 4 games a year. All right, so what does that mean? The economy has to slow down, and sometimes it'll even constrict. And remember, we did have a recession or two in the early 2000s. How about this shadow banking system? I'm not a big fan of this term because it sounds like it's devious, and I don't really think it is. However, it doesn't operate out into the open because there are elements to it that are not widely understood by the investing community. Things like securitization through special purpose vehicles, or asset-backed commercial paper, or repurchase agreements. I mean, these things are all, in and of themselves, these are not bad financial securities. In fact, they serve a tremendous purpose. But when individuals and institutions are not aware, hold on, what have I said before? identify the risks, quantify the risks, and manage the risk. I mean, that's the problem with this shadow banking system, is that, especially as leading up to this crisis, is that we were not doing any of those three things. So we had irrational exuberance, which means we're just happy and we're pretending that nothing bad is going to happen and that prices are going to rise. This, of course, leads to poor risk management because not everybody, but most individuals suffer from what's known as confirmation bias, meaning that we're only going to listen to stuff that we already believe in. Now, what happened was that there was this disrupted flow of credit to consumers. So slowly but surely, when individuals and businesses would go to borrow money, the terms were not as generous. So if you went to the bank and said, I need $50,000 to expand my facility, the banker might say, I'll let you have $30,000 and you can expand it by just a little bit. So there was this initial disruption and then it continued to flow. So boy, look at that. Those are billions. Oh my goodness gracious, on the vertical axis. So, I mean, look at this, is massive. I mean, look at the credit collateralized debt obligations and the asset-backed securities. I mean, there's massive amounts. And notice how they led up to 2006. And then, the crisis hit. And then, boy, look at 2008 and 2009. Wow. Now look at this bullet point here, in the preceding decades. All right, so let's go all the way back through the George Bush years and then back through the Bill Clinton years. We had that gigantic expanding economy. So of course, individual households are going to accumulate debt, not just mortgage debt and not just automobile debt, but credit card debt and any other kind of debt, maybe beach house debt or vacation debt, or I just feel like giving myself a raise kind of debt. All right, so what happens here? When the housing prices started falling, the priority then becomes to paying off the debt. So that reduces consumption and reduces investment, slowing down the economy. All right, let's look at a little bit of chronology here in the buildup. All right, so the first problem's early 2007 when Freddie Mac, one of these government-sponsored entities, announced that it was going to stop purchasing high-risk mortgages. All right, so remember, the banks, they were giving out all these loans and they were packaging them and then selling them. Well, if one of the buyers out there says, we're no longer going to buy these, well, then this has repercussions into the banking industry. So look at this. New Century Financial filed for bankruptcy because of that reason. And then the credit ratings agencies, maybe they were not totally accurate in 2004 and 2005, but they quickly became aware of their problems and then started some downgrades. And then there were some indexes that began to fall, lots more expectations of default. And then this trickled down to the very short-term market. My wife and I have, this money market mutual fund that we kind of use as, a combination of an emergency fund, but we also pay our property taxes out of it. We pay our school tuition out of it and all kinds of stuff. And so remember that these money market mutual funds have a net asset value of 1. That's just the way the system is designed. But then there was a run on these things and there was a breaking of the buck, which we'll talk about in just a few slides. So this money market, which was viewed almost as being risk-free, started having these runs. So large-scale withdrawals from short-term funds were made. So these used to be this big, and now they were only this big. And so lots of borrowers had difficulty, and there was a series of bankruptcies and then takeovers. This is good for solid financial institutions who can take over other failing financial institutions and buy them at a low price if they can restructure and regain that profitability. All right, Countrywide Financial, which I had my first mortgage in the house that I'm sitting at right now was bought by Bank of America. And the second thing was this financial institution, Bear Stearns, which, by the way, had a stock price of over $130, a year before 2008. It had tremendous losses, so that the price fell below $10 a share just a year later, maybe even less than a year later. All right, Fannie Mae and Freddie Mac back in September of 2008, they were put into conservatorship. That means that the federal government kind of took them over. Huge losses in the subprime mortgage market. Lehman Brothers filed for bankruptcy just a week later, really exacerbating the issue to the public, because it's one thing when these government entities like Fannie Mae and Freddie Mac, it's one thing for them to have difficulties, but then when this widely popular and successful investment bank has problems, and these problems stem from just the consequence of failing to raise capital that it needed. When Lehman Brothers failed, then this was a dramatic impact throughout the entire economy. And then we had AIG needed to be bailed out by the federal government, and then there's the breaking of the buck that I talked about in a previous slide. Now these events were not limited to the United States. Financial meltdown had spread, which means that economies throughout the world were slowing down or contracting, and then the spreads between, let's say the U.S. Treasury bill rate and corporate bond yields, or maybe the LIBOR versus European corporate bond yields, those spreads were widening. And when you have widening spreads, that's an indication that there's more risk. And when these spreads spike like they did, that's an even greater indication that there's a serious issue. And so what happened was that these banks, they all got together and they came up with a plan. They came up with a plan to kind of combat this financial crisis. So by early 2009, signs of stability had become evident. All right, look at Lehman Brothers, $239 billion. That's a number that's even hard for me to wrap around my head. Fourth largest investment bank in the U.S., 25,000 employees. And so it filed for bankruptcy. Look at this in the bold, a seismic event that shook the global financial system. Oh my gosh, equity markets lost more than 10 trillion in market capitalization. Look, if I can't even imagine what 639 billion sounds like, 10 trillion. Oh my gosh, that's like being lost in space. All right, so the Dow Jones, of course, the Dow Jones lost tremendous amount. Stocks in banks and primary dealers lost lots and lots of their value. Run on money market funds was witnessed, and there's another breaking of the bank. All right, so panic period 1, August of 2007. There were these runs on the asset-backed commercial paper market. Now, remember that large corporations, including financial institutions, have access to this commercial paper market. And most of the time, this commercial paper market works like this. A large corporation like Johnson & Johnson, who needs money in the short term to manage its working capital, can just go to the commercial paper market and say, I need $500 million, and the lenders out there, they just flood it because they know that Johnson & Johnson is going to sell enough shampoo and medical devices and all the stuff that it makes to be able to repay this back in the relatively short term. But then this animal in the 1990s, these asset-backed commercial papers in which they were backed by collateral, like some kind of an asset, maybe just an accounts receivable. So think about this. If the economy is struggling, and if financial institutions are nearing the point where they are struggling to maintain their capital, then sooner or later they're going to have a problem paying their short-term obligations, which lots of times show up as short-term assets on other financial institutions. Do you see how this is all interconnected? Oh my gosh. So if there's a problem with asset-backed commercial paper, it's not just confined to asset-backed commercial paper. This means that there's something significant going on the balance sheets of these financial institutions. So look in the third bullet point there. Collateral is the future payments on it can be mortgages, it could be auto loans and credit loans and invoices and almost anything else you can think of. So what happens is that these companies essentially borrow money today so they can invest, and they'll repay it when these homeowners and car owners and credit card users and any kind of accounts receivable, when they get paid, then they'll swing that back to the commercial paper. Well, of course, this is all related. And so what happened was that part of this asset-backed commercial paper collateral consisted of some subprime mortgages. So if you have an asset-backed commercial paper that's tied to the payment of subprime mortgages, and you're holding this piece of paper and you know all these people over here, they're not going to pay you, then this piece of paper becomes worthless. Worthless, 2 words, not worthless. All right. What was that number back there? 1.2 trillion. I don't know what that number means either. Here we go. Look at that term in the first bullet point, clobbered. Okay, the investor community was clobbered with mortgage-backed security defaults. Of course, home prices couldn't continue to rise. Of course, if you have this subprime market, that there are going to be lots and lots of homeowners who are going to default. In fact, I read a fascinating article in the Wall Street Journal that there was some county in Georgia in which there were like 50% default rate. I mean, I can't even imagine what that means. Of course, investors became concerned about the creditworthiness of these asset-backed commercial paper. But that concern then spread to mortgage-backed securities and other types of asset-backed commercial paper. That's when the panic set in. All right, so they trooped into money market funds to withdraw their capital. So commercial paper issues could not find willing buyers in the market, and they could not roll over their maturing commercial papers. Remember, the rolling over is an important concept. As our federal government here in the United States is great at that. When it issues a treasury bill, it knows that it can find borrowers to pay off that maturing debt. And so our federal government has kind of the perceived ability to infinitely roll over the debt, but financial institutions and corporations, they clearly don't. Look at that last circle down there. 40% of commercial paper programs were in a run. They could not finance themselves. That does not sound like an expanding and stable economy. Oh boy, so what happens now? We've got this Lehman Brothers bankruptcy, file for Chapter 11. That directly led into the breaking of the buck, and this led into a run on other money market mutual funds. So look at that number there, 144 billion withdrawn by investors in money market accounts. I know my wife and I, we didn't withdraw anything from our money market account, so we didn't contribute to that. But look at the bottom little illustration there, 7 billion before September 17th. 144 billion after September 17th. So what does that sound like? I mean, clearly 7 to 144 of withdrawals. That sounds like a crisis. So what did the government do? Reduced interest rates, and they did that for a long time period. They relaxed the reserve requirements. Remember, financial institutions, when it accepts $100 in deposits, it can't go out and make $100 in loans. It has to keep a portion of that, maybe $5, maybe $10, maybe $12. And so they relaxed those reserve requirements and allowed longer funding terms. They allowed for lots and lots of recapitalization and an injection of capital. And they enhanced the depositor protection regulations. So the federal government amended and massaged and changed some of its rules and its regulations and its laws. Now, how about the global effect? So syndicated lending fell. Of course it did. But commercial and industrial loans reported by the U.S. regulated banking sector rose. But an overall decrease in demand for consumer loans, whether it was measured by the number of credit applications to the affected banks or the unaffected banks, there was a decrease in the demand. And you should be up to speed. I'm thinking of the old Steve Martin Inspector Clouseau. Now you're up to speed, for those of you who like comedy movies.